Lending money. Well, I looked online just before and I didn't actually see a lot of advice that's relevant to Australia in terms of making investments where you lend money directly to other people. Now, I'm not talking about peer-to-peer lending. I'm not talking about investing it in a lending trust or a contributory mortgage trust, as they call them. I'm talking about you going out and directly lending money. Now, this is a pretty spicy place and I don't expect or encourage you to consider this form of investment. But if someone comes to you to request a loan and you feel compelled to consider an investment, I thought that what I would do is create a video on the types of things that I have considered when making a lending investment or lending my money. And this way, I'm not encouraging you to do it, but at least you'll have the information that you can kind of be semi-informed when walking into this space. Ultimately, as always, it's best to speak to people that know a lot about it, but if you know the basics now, you can then ask the right questions and get better information. So let's get into lending money. Firstly, the most important part in this particular video, simply because it's a spicy space, I'm not a lawyer, I'm not an accountant, I'm not a financial planner, and I would encourage you, please, if someone comes to request money to be lent to them, speak to one of these people to give you the right advice. And by going past this point in the video, you agree to be bound by the terms and conditions of my disclaimer, which has been linked in the comments section of this video. Firstly, what is lending? Well, basically, you give money to someone, they do something with that money, they enter into a loan agreement, then hopefully after a period of time, they pay back that money plus interest and everyone's happy. So the areas that I've personally lent money include providing working capital to a business. The other one is to a property developer to provide mezzanine finance to complete a project. And the final one is to a commercial property investor to provide some cash out for them to do something else with that money. Now in Australia, lending money personally to people is illegal without a license. So all the money lending that I've done is solely been between two businesses. With lending, the next thing to talk about is the capital stack, and there are a range of different levels of security. Firstly, you have primary debt, then you have subordinate debt, then you have unsecured debt, then you have preference equity, and then you have equity. So let's first talk about primary debt. Effectively, primary debt is when you have title over an asset, whether that be a property or some form of other asset, and you are the first rank of security on that asset. Generally, it's also up to 60% of that asset's value in terms of the debt to equity ratio, and the rates on this are generally anywhere between 3 to 5%, which reflects the risk of holding title over that asset. Also, this is the largest chunk of many debt deals, and being that it's 60% of the total asset's value, it often means that it knocks out a lot of potential investors. The next ranking debt is subordinate debt, or in the property development space, it's called mezzanine debt. Effectively, it means you have second ranking mortgage on the asset. Generally, the debt to equity ratio cap on this is up to about 80% of the asset's value. And if you are lending money when there is already primary debt security, often you'll have what's known as an intercreditor deed, and basically it's an agreement between you and the primary debt holder as to what would happen in the event of default between the two lenders. The rates on this type of investment are generally between 15 and 25%. The next ranking debt is unsecured debt, and effectively what that means is the borrower, at a general sense, on all assets that they hold will repay you, and in the case of a default, you may have a claim on all those other assets. Now that is the difference between primary and subordinate debt and unsecured debt, is you don't actually have a claim over the individual asset's title. This space is kind of like credit cards, where the unsecured debt facilities is normally around about 25%. Then we move across to a slightly different structure, which is called preferred or preference equity. And depending on how the ownership structure of the asset's set up, effectively you take a preferred right in terms of a payout over the ordinary equity holders, whether it be in a unit trust or a company structure. Again, this is a pretty murky area. You should speak to a lawyer to clearly understand it. Effectively, you don't have title over any specific assets, and rates are generally 15 to 25%. And the final level is equity, and the unconventional way I think about this is effectively the deposit or the hurt money that the borrowers put up that they could potentially lose in the deal if they default on the debt or preferred equity. And have I mentioned lately that you should subscribe to my channel, because I feel like I haven't asked you in a long time to hit the subscribe button and like this video. At a high level, what is the process of lending money? Well, firstly, you have a loan term sheet, which you outline the basics of lending money, which then progresses onto the due diligence of the security, the borrower and the deal, which then turns into the loan documents. Then the loan documents goes into a very important stage, which is the registration of security and settlement of the loan, where the money actually goes out to the borrower. Then there's interest, and then there's a repayment, and then there's a discharge of the security. At a high level, what is covered off on a loan term sheet? Well, the first thing to consider is a debt to equity ratio. Effectively, it's the amount of borrowings as a cap divided by the total underlying securities value. Also, you cover off things like the rate, the term of the loan, repayments and drawdowns, the security that you're going to have, and also what necessarily is the purpose of the funds. Then we move on to due diligence, which is basically the trickiest question, which is this borrower going to be able to repay my money? The first kind of question you want to answer is the borrower sound character? So looking at their credit history, looking at their track record and other deals, or the purpose of the funds and what they're looking to deliver. You can speak to other independent third parties, such as their accountant or maybe subcontractors if they employ other contractors. And finally, why are they actually coming to you for the money? The next question is how will the borrower actually pay back the money? There are a few ways that they can consider doing this. These include selling off the secured asset to pay back the loan, selling off another asset to pay back your loan, refinancing the secured asset to pay back your loan, or refinancing another asset to pay back your loan. And finally, getting an income from somewhere else or the secured asset to pay back the loan. You need to understand the business case of how they're going to make a repayment, and ultimately there needs to be a win-win. They gain something, you gain something. Then you need to look at the likelihood of the plan A business case, and also weigh up what happens in terms of a plan B, or what is another form of exit strategy for your loan agreement, or how else will you get repaid if something goes wrong. Then we transition onto the security, and the questions you need to ask yourself is, do they even own the security? What is the value of the security? Is the security liquid, or could you sell it if you needed to? Is there more senior debt on the security? How much equity between the senior debt and the facility you're providing, so that you know that there is some money on the line should they not repay the borrowing. Then we want to know what the money is being used for. Are the funds being used for the business case, and do the funds improve the value of the underlying security? Effectively, the main question is the likelihood that you'll be able to get your money if you had to sell the securitized asset. Then it's important to check the track record of the borrower in terms of executing a business case. If it's a property deal, for example, do they have pre-sales to prove that there is a market for the underlying property? Have they had a QS check the building contract independently? Is there a valuer determining the value of the secured asset or the feasibility of the property development deal? Concurrently to all of this, while your legal team is looking at all these other items, they also need to look at what type of entity the borrower is borrowing in. Is it a company? Is it a trust? And of course, as we said before, if it's personal, then you need a license to be lending money. If we've passed due diligence, the next thing to move on is to the loan documents. Effectively, what happens is the term sheet gets migrated into a practical document about how it all actually takes place. For example, what happens in the event of a default? If there's drawdowns, how do they happen? If payments need to be made, how do they happen? And if there's security that needs to be taken over assets, how does that practically take place? This, on top of all the other areas, is another area which you would need a lawyer to give you advice and provide the document. The loan documents are now signed. This is now settlement, where the money is paid to the borrower. Effectively, there are a few different ways you can cut and dice this. It either goes into an account, or if it's a property development deal, I've liked to pay invoices directly in the past, so I know the money is going exactly to the people that is the intent of the loan. Concurrently to sending the money out, you then register security over an asset, provided that it is a secured loan, and you can get security of a range of different assets. For real estate, you have a mortgage or a charge of the title or a caveat, and for plant and equipment and other assets, you'd often have a registration on the PPSR, or the Personal Property Security Register. As a very important tangent to lending money, I want to talk a little bit about separate legal entities and the event of a default. Firstly, if you lend money to a company, Assets within the company could potentially be your security, provided that there's already not a PPSR registration over plant and equipment. So remembering, if you have a loan to a company, that doesn't necessarily guarantee that any machinery they have is yours, provided you have a PPSR registration. Also, if the person who found that company is driving around in a Lamborghini, that might be personally owned, and that doesn't necessarily mean if you lend to that company, you have a right to take that Lamborghini. So, remembering, if you are lending money to an entity, you only have a right to whatever you are holding within that entity. There could be other charges on other assets within the entity, and assets that you see may not be held by that entity. So it's important when you're doing your due diligence to make sure you clearly understand what assets are in the entity, and ultimately, if you are taking security over the entity, you may also want to take over security over assets within that entity or other entities if they are guaranteeing the initial debt. And while we're on this topic of tangents, let's get on to lending myths. And the first one is interest rates. Firstly, you can charge what interest rate you like, and in the event of a default, you can crank up the interest rate to whatever you like. This is not the case. If a court deems that the interest rate you are charging is excessive and it's disputed, then the court can elect to reduce, defer, change, alter, whatever the court wants to do to the rate. So you must speak to your lawyers about what is considered a fair rate based on other civil examples. The next one is defaulting on a loan means you get to take the asset. Again, this is not the case. For example, if you have a borrower and they can't make the payment and they have a property and you only have $2 million in debt and the property is worth $10 million, you can't just go and take that asset for $10 million and keep the additional $8 million of difference. Effectively, what would happen is the asset would get sold, you get your $2 million back, and they would keep their $8 million. So remember, just because you have a charge on that asset doesn't ultimately mean you have a direct right to take that particular asset. And finally, again, with an urgence of caution, personal guarantees or director guarantees aren't necessarily worth the paper that they are written on. Yes, in principle, I understand that person has a right to repay that debt, but ultimately, people are pretty smart, and the whole premise of separate legal entities, people can hold assets in either other entities such as discretionary trusts or in their wife's name, and if they've signed a personal guarantee and the company that they solely own is defaulted and they have no assets in their own name, ultimately all you have to come after is their goodwill and bankruptcy. I have skipped over the payment of interest, the repayments, and the discharge of security, and the reason for that is, again, is a reminder to be super cautious of going into a debt deal. Forget about the back end, forget about all of that, that's great, but you've got to make sure you do the front end correctly first, get the right people, do it the right way to make sure that you reduce the risk of not getting paid back. So until your next lending deal or my next video, best of luck and goodbye.